Okay, good evening to all of you and welcome to yet another panel discussion. We're just 2 panels away before we hit the bar. So we'll try and make it as entertaining and as interesting as possible for you. So, this panel is basically about, how fintechs are navigating the regulatory landscape. And when we are talking about regulations over here, we've heard a lot about RBI. But when we're talking about selling financial instruments on the internet, we have to talk about SEBI. And basically what does SEBI want? SEBI wants the right kind of investments to reach the right kind of investors in the right possible manner. That's from 30,000 feet above. But if you dig a little deeper, and I don't know how many of you all would have caught SEBI Chairperson Madhvi Puri-Buchu's speech in the Fintech Conclave a few months ago. But she very clearly articulated 4 or 5 things that, fintechs, that SEBI expects fintechs to have. So for example, anonymity is not welcome, the kind of anonymity that crypto offers. Things have to be transparent, things have to be properly laid out. Fintechs should not only just make it easier for customers to come in, but also make it easier for customers to get out. What she calls is as the Abhimanyu complex. That is not looked upon well by the regulator. So this is what I wanted to ask from my panel today as to how they are navigating this regulatory concept when they are taking their financial products. For example, we have an online bond trading platform. We have a couple of stockbrokers, online stockbrokers. We have Fisdom, one of the earliest entrants in the fintech space, selling mutual funds. And then we have a product manufacturer, Radhika, Gupta, who needs no introduction. So, how are fintechs basically taking the right product to the right customer in the right possible manner? So, Nikhil, let me start by asking you. You own Grip, which is an online bond trading platform. I mean, we've had stockbrokers for many years, but getting bonds online to the retail customer is the newest animal on the fintech street as far as financial investments are concerned. And you typically characterize the fintech space that innovation happened, a new idea came about. SEBI watched you. SEBI said that, okay, this is an interesting proposition. You're dealing with the retail investor, but you're not yet regulated. So let me now come in and regulate you. So SEBI came out with a detailed set of guidelines in November, articulating what online bond trading platforms can do, number 1, 2, 3, 4, and what they cannot do. So if you can just give us a sense of, how things changed, because, a lot of online bond trading platforms were already there in circulation. A lot of exotic instruments were already there. So how did you revisit the drawing board? What did you stop? What did you restart? And how did you make that transition? Not just for Grip, I'm just saying for all your peers.
Sure. Thank you. I think, just from where you started the question, as a founder of most fintechs, I think the first thing is the intention is to run away from regulation or regulator because it always feels overbearing. And in the desire to grow fast, you believe that this is something that is going to weigh you down. I think what has changed for us, and that speech that the SEBI chairwoman gave, was to say that regulation can be inclusive. And if you move in the right way towards the spirit and philosophy of regulation, I think that's the opportunity to create a large business. Otherwise, you're just operating in the niche. The bond trading platform regulations are an incredible step forward in that direction. Right? I think they've tried to do 2 things, and I think everything that has been said in this conference today and that we have seen from regulators and government is to achieve a balance of 2 objectives: allowing innovation to happen while protecting the interest, especially of the retail user, of the retail customer. The bond regulations enabled a reduction of 90% in the face value of bonds from 10 lakh rupees to 1 lakh in face value. At the same time, which is great for market development, but at the same time said only listed rated bonds must be available so that there is KYC, no anonymity, and exit is possible. I think that balance was achieved and actually gave in a way a stamp of approval to say, let's make this industry viable, let's deepen the markets, but keeping in mind certain frameworks and guidelines. To our extent, we've been able to now only focus on those bonds. The clarity exists, right? And clarity is great for business. So we've been able to move on our platform, on the bond side, to only listed rated bonds that are available. In fact, we've also set a criteria internally that it will only be A-rated bonds, right? And hence give a further curation.
Only rated A and above.
A and above rated bonds. I think that's number one. And definitely there are steps that we need to take for compliance reporting, but I think that's good for business. I don't see any big company getting built in any fintech sector across the world without taking those steps for regulations. It's processes. I think the second part which we've been able to change in the last 6 months is look at the spirit of what SEBI is saying, and can we introduce other fixed income products that also meet that spirit and that smell test. We've been able to introduce a securitization product, which is also listed rated on the market, and that has become interesting for users to participate in, right? I think a lot of our peer set are now thinking in the same direction, and the combination of having a license, having a clear set of framework in which to operate, will allow more people to create products that will actually benefit the ecosystem.
Radhika, you know, we've had, you've spoken a lot about bonds. You know, you have, thanks to your Bharat Bond Target Maturity Fund, and you've been selling bonds from a mutual funds perspective. You know, we've had, you know, we know anecdotally that investors understand equities better than fixed income. And, you know, debt is obviously can get complicated. Even fund houses have got, you know, their, you know, debt calls wrong at times. And we have had, of course, a few accidents in the past 3-4 years. So one is obviously Nikhil was elaborating upon innovation and you know, reduction of face values, et cetera, but do investors understand fixed income well enough for this innovation to work? I mean, there are two sides. One is that, of course, there is innovation, but the other side is people don't understand. So is it really required, or what can online bond trading platforms do to sort of make the experience easier for investors?
So you had to start by throwing curveballs at me. My only plan for this panel was to have fun with Kezad, but he switched that game. Look, I have probably been the flag bearer for innovation in the bond market. And I want to make 2 points here. One is there a need for innovation, effort, rethinking, retooling in the bond market? Absolutely. I think so much of the narrative around the last 3-4 years about new investors coming into the market has been equity. And there's no taking away from the hard work that has been done there, and it's necessary, and it has a lot of good second-order impacts. But Indian consumers are fundamentally savers. And you know, you have 150 lakh crores sitting in fixed deposits. You have so much money sitting in insurance products. I mean, tax has changed, but in the guise of long-term, you know, debt investment. Is there a space for reforming bond investment? Absolutely and completely. So, and by the way, I do think, and we have had multiple conversations with the regulator beyond Bharat Bond in thinking, you know, I think the regulator also wants that. So deepening the bond market, rethinking about the bond market, I think is something that is important to everyone. Now, on the second point, I do believe bond investing should be simple. So to your point, Kezad, you know, anecdotally, as a product manufacturer, we've seen that if something goes wrong in an equity fund and you have a 20% cut in a small cap fund, or you know, any of the stockbroking guys will tell you if there's a 30% cut in a stock price, there's not hue and cry about it because consumers understand equity risk. At least I think Indian consumers understand equity risk. Consumers don't understand bond risk. Indians come from a fixed deposit mindset. So they take the fixed word and fixed income very, very seriously. We know that when liquid funds are negative for a day, it creates a furor. So the steps the regulator is taking are welcome. And I think bond platforms, and I've spoken to multiple of them, really have to think about a couple of things. One is the selection of bonds that you have. I'm very encouraged, by the way, to hear that now there's a filter that's single A. You know, in my opinion, that should be more than that. But anyway, I think at least a credit-based filter is important. The second thing is liquidity in bonds. So to the chairperson's point, you know, as large institutions, we already struggle with liquidity in the bond market. So if it's difficult for a consumer to exit a bond product, I think that's the source of hue and cry. And even in our own industry, I think the issue has not been credit. The real issue happened in fixed income when there was a liquidity issue, and we know what we're referring to. I think two, and the third is transparency and disclosures. And I think historically, when you look at issues that have happened around fixed income or arbitrage products, even things like NSE, they have somehow fundamentally been related to transparency. So my concern with online bond platforms is if you're selling a high yield product, sell it as high yield. And make sure the consumer knows that it is high yield and that is what high yield can entail. And if you're able to get this right and innovate with right selling, then I think it's a very powerful construct.
Liquidity also, you said it's very...
Liquidity is extremely important because finally our consumer is a fixed deposit consumer, and the promise of public investment products is liquidity, is that I can get my money back without thinking. And when there is a liquidity event, it sets all kinds of questions in the minds of the consumer.
So, Nikhil, just one more question before I go to the equity markets. But, you know, Radhika said about liquidity, that's a very important point. I mean, do you have any, I mean, what's been your experience with your investors when they want to sell bonds? Have they been able to easily get out of these online bond platforms at a time that they want, at a price that they want?
I would add one more dimension. I think it's the profile of the investor. Right? I think if we look at that, and you know, in the session before we talked about the 80% of the user and the last 1% of the user, right? We're a very diverse country. Things work very differently. There are a set of users in this country who will tell you, I don't ever want to have liquidity. Please reinvest all of my returns and give me a maturity product after 10 years. I don't want to deal with reinvestment risk. And there'll be a set of users who says, I want everyday liquidity, right? I think being as a platform, and that's what technology empowers you to do, to be able to also put a filter on who your user is, right? And the persona of person you're targeting is very important. Right? Over the 3 years that we've been in operation, we don't have a single person who's come and asked us for liquidity. Forget the concept of being able to provide it. There is no ask for liquidity.
So people have not sold any bonds that they've bought on your platform, not yet.
Yeah, no one's come to us and said, either please help me sell, or I'm not able to sell, please get me out of this, right? And bond markets, to Radhika's point, have very little liquidity, right? I think that's one of the things of making it available to retail at smaller ticket sizes and encouraging more issuers will create that liquidity, right? Okay. And we all have a role to play in making that happen. But the set of users that a bond platform should target today, and what SEBI has done by putting a 1 lakh rupee check is to cater to a set of people who don't necessarily require liquidity. If you look at P2P as an example, you know, most P2P platforms today have seen significant volumes because of offering any-day liquidity. But a very different consumer set invests on the P2P platform where a minimum ticket size can be as less as 1,000 rupees. Okay? So that's the difference we're seeing. I would completely agree with Radhika's point on on transparency, right? And that's where, again, SEBI's requirement for having a rating ensures that there is a clear demarcation for any user to at least have one check in place to say it's AAA, AA, BBB, and have some sense of what that yield is likely to be or what the risk is likely to be.
Okay. Let's talk a little bit about equity markets. Prakarsh and Pravin, both of you all, I want to take this too. As far as equity broking is concerned, a lot of regulations have come in the past, 2-3 years of client segregation, quarterly settlements, business sustainability plan, etc. How has the transition been? This has all come at a time when the COVID rally has happened, work from home, and, people started the majestic COVID rally, which happened in 2020, and so many new investors have come, first-time investors have come. And at the same time, you have to balance it out with additional regulations which could make life tougher. Many fintechs at least tell us privately. Where do you all stand, and how do you see this transition happening especially for online fintech platforms when they are actually trying to penetrate?
So Kezad, on a lighter note, see, regulation or regulator is like exams. When you're in school, you don't like it, but you don't have a choice. But you have to just go through that. But at the end of it, when you give it an exam, you always come out wiser. From an annual exam, now we are almost on a daily or a weekly exams in last 2.5-3 years. So, but see, no
Do
one.
you think it's an over-regulated or?
No, actually, we were very under-regulated. See, if you look at broking industry for last 20, 30 years, there has not been any entry barrier in the broking industry.
Radhika, is mutual fund industry over-regulated or under-regulated? Okay. I'll come back to you
Because you're
again.
trying to play games with both of us, and he hit the ball out of the park, so I have to represent. I think we sometimes complain about regulation, but we've become a 40 lakh crore industry because we are the best regulated industry in the country. So I'm only thankful.
That I agree with you. Yeah,
So there were no entry barriers in the broking industry. Anyone who has a broking card could actually start. That created a lot of problems over the years. What has happened is that because of technology and nowadays exchange regulators, no one is categorized as a broker or an exchange. Everyone is fintech. Exchange is a fintech, clearing corporations are fintech, brokers are fintech, depositories are fintech, because everyone every day is talking only about technology. And that is the reason and that is a catalyst why you see so much of changes which has happened in last 2.5, 3 years. Because technology could enable all that. It's just that because we are all averse to change, and that is the reason why everyone feels the pain of the change, and it is taking you out from your own comfort zone. But if you look at in last 2.5, 3 years, what has happened? We never saw the kind of demat account growth. From 3.5 crore, we are at 11 crore demat accounts. Broking industry, which was restricted to top 5, 10 cities, is penetrated across the country. You have millions of investors coming into, into direct investing, either investing into stock market or through mutual funds, but they have come. Third, everyone as an investor today feels safe. Even we all are on the other side, but we are also investors. Today we feel safe. Why? Because your shares are there in your depository, which you can see, which is again regulated. Your money can come in and go out as per your convenience. Your dividends, your corporate action, everything comes to your bank account. So there is a lot of security. Even the stocks which are listed on the exchanges, even the companies which are listed on the exchanges, they are far more regulated. So you don't have companies going bust, which used to happen in 94s and 96. There were plethora of IPOs used to come, and after 4 or 5 years, the stock prices used to be in some paise. So the change has been very good. What has also happened, there is a consolidation. If you look at today, broadly 70-80% of the market is consolidated with large players. When you have large players, both on the banking side and on the broking side, it brings credibility. You have deep pockets, and that's why you are able to do everything which a regulator wants, what a customer wants. So I think overall in last 3 years, I think it's a phenomenal move. Though we all are, we all chat sometimes. Pravin is smiling that what is the pace of regulation? Like every day we come to one circular. So today also there is a circular on the guidelines for cloud infrastructure. So you have to go through all that and do it. But I think it's all good. The costs go up, but end of the day, customers will also realize that whatever we are charging is not. We are actually paying them back by making the system more better.
Does it impact fintechs more than offline brokers, or it impacts the entire ecosystem?
It has impacted more offline brokers because one day on 22nd of March, on 2020, you realize that your offices are closed. So people who are digital there could survive. People who are not digital by then, I don't know, perished. So people who are into fintechs, who have adopted digital, they are the ones who are thriving and growing. And that's why I think all of us are sitting here.
Pravin, you're the newest kid on the block, right? Raise Financials. So, you're coming at a time when so much of upheaval is happening, so much of inflows is happening. What is your sense?
I'll just quickly add on what Prakarsh actually said. Okay, it's like giving an exam every day. Just the different part of being a stockbroker is, you have. I tell my other friends who are fintech founders in credit or payments and all, you have only one headmaster to go and answer to. Okay, in our case, we have headmaster and we have teachers. Okay, which has exchanges. There are 3 exchanges. There is depository. There is a KRA and all. Okay, so the amount of exams that we have to give as a stockbroker is probably every day we have to repeat 5 exams, and it's before we could interpret a circular. There's the next one. Okay, and we are still trying to figure out. Okay, do we have a revenue line or do we have a customer line? What is the cost of impact? And so on. glad. I think I should be, again doubling down on what Prakash said is, I should be glad that we got into this business, okay, before this set of regulations came in, okay, because I think most of the regulations are now, okay, to curb a lot of menace that has happened in the history of stockbrokers. I'm sure everyone has an example from their friend or from someone they know in the industry about one fine day the broker vanishes, one fine day the shares vanishes, when the money goes off. And there are enough and large examples, I think everyone knows about it, okay. So all of this is done with a view of, hey, let us understand that no entity can simply register and get a stockbroking certificate, and you have a right to hold customers' money and the shares. Obviously, it's in depository, but a lot of controls that go behind. I think from our perspective, okay, we probably, when we also discuss internally amongst our teams, we say to ourselves that, hey, we're a financial services company, okay, because I think with the circle of friends that we have in fintech, okay, I think we overvalue a lot of tech and undervalue a lot of regulations and all, okay. I think that unfortunately is changing, not by design, but by regulations now, okay, becoming stricter across all domains, not just about stockbroking. The good part is today there's clarity amongst a lot of new players in terms of what is that I'm picking up for. Okay, so if a new broker is coming up, they know that, hey, these are the regulations that we need to follow. This is the capital allocation that you need to bring to the table. Okay, you can't be a small-time broker and then get a license and then figure out a way to do that. How does this all line up? Okay, if you just go to a SEBI website, you probably see there are around 5,000 odd licenses in the market. Maybe around 900 plus are active right now. But if you look at data on NSE, you'll see that almost 90% of business today is done the top 25, 30 brokers. Okay, so if you're not among the top 30, 35 brokers, okay, you probably don't see the next 300, 400 surviving the next set of regulations, because they are highly demanding on product, highly demanding on technology, highly demanding on infrastructure and all. So it's clearly we will not have a market of 1,000 brokers. We probably have a market of 25, 35 brokers. And how it evolved in some of these developed nations is that you look at US as a market, okay, I can't name more than 10 brokers. Okay, so I think eventually down probably 5 years down the line, 10 years down the line, okay, we might be in a scenario that a few brokers, probably for India's large market, maybe 10, 15 brokers would survive and all, but the kind of business that you will do, okay, is going to be a clear business. It's well-defined, well-regulated, where investors, when they're putting money, okay, they don't have to look at. In fact, before this, okay, I'm sure a lot of my mutual fund colleagues or my friends know in the industry, when I built the earlier version of our product, which was a Paytm Money, when we built a product for first-time investors, okay, we saw a lot of investors coming and putting in like the first 100 rupees, okay, of their investments. And we were surprised. They are withdrawing this amount, okay, on the third or fourth day. And we happened, what is this behavior? Why are you putting money and withdrawing? And the customer mindset out there is, no, we want to check ये चलता है कि नहीं चलता है. मतलब पैसा जाता है वो ठीक है, पर पैसा वापस भी आना चाहता है, okay? So I think those kind of fears, okay, which a regular investors would probably have, I think those fears will not be there, okay, going forward. So the way banks are looked as, an institution of trust, I think eventually a stockbroking industry will also evolve to that phase where you are not just a mom and pop shop, okay, you are a financial services company which is offering a highly regulated product within the guidelines of what's defined in the industry.
But so convenience, ease of use, definitely, transparency, definitely are good fallouts of regulations as you have articulated. I just want to play the devil's advocate for a second and ask you, do regulations tend to kill innovation? I mean, you take your example, you are one of the latest entrants in the market. How are you going to differentiate yourself from other existing players who've been around for, years and decades? I mean, with your, boundaries being set every day, how are new brokers or new fintechs who are going to come in, enter the space and make a difference?
I think this is my personal philosophy, by the way, okay, that no product is ever built, okay, till you actually, go and talk to customers, okay, and that's what most of us do at Raise, okay, we talk to our customers day in and day out. So if you look at payments, okay, we are all surprised that India has leapfrogged so much in the last 10 years when it comes to payments. But if you look at wealth, okay, I think digitalization of wealth is happening today. A lot of folks don't realize that the underlying exchanges today are interoperable. The clearing corporations are interoperable. The KRAs are interoperable, okay? And that gives a significant benefit to everyone, okay, for making sure the customer onboarding becomes easier. Now, what do the products that we are building, okay? So if you look at the products that are always been available for the last few years, okay, I think most of them were probably similar to each other, right? Okay, like we are competitors, but obviously, okay, someone invests via us and someone invests via 5paisa, okay. The guy investing on 5paisa is not going to get better dividend, okay. He's going to get the same dividend with the company declares. So all of us have to go ahead and figure out, okay, can we build features on top of that? Can we make his life easier as an investor?
More analytics, more
analytics, more data, more signals and all. And there are tons of opportunities like that, okay. And we believe India payments has leapfrogged, okay. There are a lot of folks today building on top of other digital infrastructure on lending side of things. There's account aggregator coming up and all. So these are things which will bring a lot of new opportunities. I was recently at an event in Singapore, and it was a Singapore Tech Fest, okay, and people were discussing about the innovations that Ministry of Singapore wants to bring along. And I'm like, hey, these are things which are already happening in India. Okay, if you look at India as a country, I don't think any other country across the world is seeing so much innovation or so much triggers that are going in the digital infrastructure. Like UPI is the one which is most talked about. Okay, there is account aggregator, there are interoperability of all the platforms that we are talking about. Okay, and so on. Okay, and this is across. There is ONDC that we spoke about. There are other things that are coming up across all the platforms. Okay, so there are enough triggers, okay, that are available across the systems today, okay, that will make innovation possible. And the journey of building a better product never ends. Okay, so that's how we operate.
Fair enough, fair enough. Subramanya, you've been one of the early entrants in the fintech investment product space, right? I mean, you started your Fisdom in, 2015, 2016. And, a lot has happened since then. And many other players have also come in. Now, one thing that really fintechs brought on the table for investors is so much of wonderful way of investing and making it easy for them to do KYC, completely paperless way. As Pravin was saying, a lot of analytics, a lot of data at just a fingertip. Your UI is so smooth. I mean, with a few clicks, you can get to know, details of your mutual fund portfolios and everything. The challenge is that sometimes there is so much of information that, we can see technology everywhere. But what about the financial planning? Like, for example, I'll just give you an example. Like, I mean, when initially fintechs used to sell mutual funds, they used to give us like best 1 month return, 2 month return, 3 months returns. And, all we used to see was sector funds and thematic funds at the top. Now, that's a lot of smart user interface, but is that really the right way of selling? And then, investors investing in sector funds and tech funds without understanding what these funds are, the risk return, your risk assessment gap. So, when fintechs plan to get products out, what is more important for you as a developer, a technology hat or a financial planner hat? What do you wear?
Yeah, so thanks, guys. I think the first 5-6 years, everyone has spent time just creating access. I think advisory, helping customers reach their objectives, I think still is work in progress. And the reason is just sheer numbers, right? So maybe it's segue to the earlier question you asked. I think there are 10 crore demat accounts, probably the unique demat accounts, for some reason the DPs don't publish. It's somewhere in the 3 to 4 crores. Active MF investors, the other day the number came of 3.6 crores. And number of active traders is probably 2 crores. When I say active, someone who's placed at least one trade in the last 12 months. So the numbers are still small. Against these numbers, even a number that we all believe is really, really less, which is the number of people who file taxes, even that number is more than this number. So there are like 6 to 8 crore people file taxes, right? So everyone's focused on just providing access. How do I get someone to start trading or making an MF investment either the fastest way or the easiest way? How do I just make the customer just cross the hump, right? I think last 6-7 years has been spent on just on that, which has also been aided by Aadhaar, eKYC, and all of that. So now I think we've come to a critical mass where all companies have to think of beyond access. Why? 2021, you could touch a stone and you could make money. 2022, generally people lose money. And 2023, anyway, there's a slowdown in kind of new demat accounts, unique demat accounts that are being opened, right? So I think the market is kind of forcing people to think about financial planning, helping customers reach their end outcomes. I think there's very little work that has been done because everyone around this table was busy just creating access. The industry was engrossed with simplifying KYC for 5 years. Like Pravin and I worked together in Bangalore when he was in the earlier organization where we spent hours and hours together just figuring out, hey, listen, look, how do we simplify KYC? And I think it was a success. Now coming to this question about how do we help customers, make right choices. I think this is where more information we have about the customer, we are able to provide better advice. If we ask the customer to provide more information, customer is not going to give. There's just no way. KYC itself was a pain in the neck, right? Aadhaar KYC is simplified. In the absence of additional information, we just have to do rule-based, look, you ask the 3 questions and you answer. I think the account aggregator framework will probably help in aggregating customers 360 information about assets, liabilities, and ability to provide right recommendation. But that runs into the RIA regulations, which are, I would say, pretty stringent. It provides a certain highway to operate, but it also puts kind of restrictions in terms of what we can and what we cannot do, fiduciary responsibilities, which are all in the right sort of frame of reference. But the challenge is the following, right? One of the, you said we started in 2016. The key thing that's changed from 2016 to now, Kezad, is in 2016 it was all about, build fast, break things, and now it's all about be compliant. Right? That's the change in the language of startups, particularly fintech startups from 2016 till now. And the reason was, all startups have product managers. And if you talk to any product manager, they'll say they want to build features for 90% of the users. And it's a very common thing to say in startups, hey, listen, look, it's okay, ignore the bottom 10%. No one cares about 10%. And regulator thinks exactly the opposite. Regulator stands for the last man, and startups want to build for the 90%. And so to that extent, unless there is a DNA of regulatory compliance, there's a fundamental conflict between the way a startup, in the traditional definition of a startup, approaches a business problem versus the regulator approaches. And I think we've traversed the journey today. Every fintech startup, has moved away from build fast, break things to be regulatory compliant. I think the next wave of opportunity is clearly in advisory. Advisory, I'm using it a very loose word, not necessarily in the RIA kind of guidelines, but helping people reach whatever their financial goals or objectives are.
Putting the information out in the right way.
I think, I think information out in the right way is an easier problem, if you ask me to be honest with you. But given where the maturity of the market is, customer awareness is, I think probably we'll all have to do more in terms of being able to ingest the information and make honest recommendations to the end customers, which clearly overcomes the principal agency problem that we've had in the industry for a long time. So if you ask me, the next wave of innovation will be in providing honest advisory to the end customers.
Radhika, do you agree with this? I mean, when so many fintechs are, giving out, schemes and performances and investment, I wouldn't say investment ideas, but, loose recommendations. Are they coming out in the right way, or is it too much of technology and less of financial planning thought process that goes behind it? Because remember, these guys are targeting direct investors or do-it-yourself investors. Whereas, you've spoken about the virtues of, having an advisor holding your hand or having a distributor holding. And here the plus side is that there's so much of convenience, easier for people to get in, penetration happens. But the flip side is, are we seeing the right funds? Are we seeing getting the right information, getting the right messaging?
I'll tell you a 30-second story and then I'll ask from a fintech platform. Sometime in 2019, I used to get about 8,000 SIPs into Edelweiss Greater China Fund. And I'm not convinced all those investors knew anything about China. And it was largely through fintech platforms because it fell into one of those top 6 months, top 1 year, etc., things. And then 2020 and 2021 happened. In fact, we were the fund house that was not recommending that fund. And Many fund house CEOs will tell you they get money into funds that they completely sometimes have forgotten because they have too many schemes through these platforms. I would love from the bottom of my heart to see a fintech platform that shows me the fund that is down 30% over the last 1 year, but is really good on a fundamental basis, because we always say Warren Buffett, you know, greed, fear, all of that stuff. I would love a fintech platform that marketed Edelweiss Greater China Fund when the PE was 7 and the last 1 year return was 30%, because truly customers would have made money. And I think genuinely, I mean, you know, he made a great point. The first era of fintech was access. But I think access is now commoditized. If as a fintech platform, you have to differentiate, you have to move to the fin part of the fintech, right? We live in the era of ChatGPT and OpenAI, where a lot of stuff will be democratized. But here is where a smart fintech platform will now add value. And I think the one thing our industry has taught us, perhaps an older industry, is that it's good to get customers, but it's very important to make sure those customers have the right experience and they stay.
Thank you, Radhika. And I think we've just run out of time completely. So thank you so much.
Kesar, I just would like to add what Pravin, what you asked about the innovation in fintech, in regulatory environment. To be really honest, it is very difficult to innovate when you are regulated. If you look at every innovation across the globe, even in India, the innovations have happened either by government, which is Aadhaar, UPI, all are government entities, or innovation has happened outside the industry. So if you look at broking industry, actually innovation has not happened in broking industry at all for the last 30 years. We still do the exactly same thing. It's just that from shouting in the ring, we are now chatting on the Telegram chat. That's not change. What in finance, more than innovation in fintech, what is required is to keep your eyes and ears open, see what innovation is happening in technology around the world and how can we adopt it better. I think adoption here is more critical than innovating. So just wanted to add what
So
Pravin
one
said.
person is saying technology of fintech and one person is saying fin of fintech. But anyways, we'll both have their own fair points. So we'll end this discussion over here. Thank you so much for being patient with us. Thank you. And a big round of applause to the panel.